What is the result of a great credit history? It is your credit score. But have you ever wondered what goes into credit score calculations and how you can control your score? In this video, I'm going to reveal how your credit score is calculated and show the exact 5 factors that go into the formula. I will discover exactly what affects every part of your credit score so you know what to focus on to make sure you always have an outstanding credit history. Hello, I'm Ohan Kayikcan, also known as Ohan the Money Doctor. If this is your first time on this channel, thank you for stopping by. If you are a returning subscriber, welcome back. I'm a doctor of economics and a certified financial planner professional with over 20 years of financial industry experience. This YouTube channel is about simplifying personal finance, saving, investing, building wealth, and self-development. Let's talk about how important credit scores are. In the US, they are a big deal. Whether you are applying for a car loan, mortgage, or any kind of credit, your credit score is checked. Even when you want to rent a house or apartment, landlords might ask for your credit score. They use it to see if you are likely to pay your rent on time, and your credit history helps them to make a decision. Now let's see how credit scores are calculated based on your credit history and the role of major credit reporting agencies in the United States, focusing on FICO scoring model. Credit scores are calculated with scoring formulas that use the information available in your credit report, which is your credit history. Think of a file that contains your personal information, account history, credit inquiries, and public records. This information is reported by your lenders and creditors to the credit bureaus. Credit bureaus are also called credit reporting agencies. More information about credit inquiries coming up. A big portion of this reported information is used to calculate your credit score to inform future lenders about your credit worthiness, which means how risky you are as a borrower based on your credit history, income, and debts. Here in the United States, there are 3 major credit reporting agencies: Experian, Equifax, and TransUnion. While there are many different credit scoring formulas available, the vast majority of lenders, or at least every single one of them that I interacted with over the years as consumer and as an ex-banker, are using the FICO credit scoring model. Your FICO score is generated from the information you have in the file with above-mentioned 3 major agencies. And we will focus on the factors contributing to your FICO score. In case you are wondering what FICO stands for, it is Fair as a Corporation, the company that developed the FICO credit scoring formula. Now, let's see how your credit score is calculated. Your credit score is influenced by 5 key factors. While all 5 factors influence your credit score, none of them are equally important. I will explain each one of these factors separately, but at the beginning, I will focus on 2 that matter the most in the FICO scoring formula. First factor, which has the biggest impact, is your payment history. This affects 35% of your FICO score. Lenders primarily look at whether you have consistently paid past credit accounts, like loans and credit cards, on time, and for how long. Unfortunately, even one missed payment can hurt your credit score, let alone multiple late payments. That's why it is crucial to always pay your bills, including mortgages, car loans, and credit cards, by their due date. For credit cards, making at least the minimum payment on time is the key. The second factor is your credit utilization, which affects 30% of your credit score. This is the second largest factor. Credit utilization simply means how much available credit you have and what percentage of that availability you are using. For example, if you have $10,000 limit and you carry $2,500 balance, meaning you spend $2,500 from that limit, your credit utilization is 25%. $2,500 is 25% of $10,000. You should generally aim to keep your combined credit utilization below 30%. This means, in this case of $10,000 available limit, you should aim to spend no more than $3,000. When you carry high credit balances, the creditors consider your situation more risky. In their mind, They think maybe you will have a hard time making your payments on time or potentially will default on the obligation, meaning stop making required payments. They can decline your new credit or loan application, or even if they approve, they will charge you higher interest to compensate for that risk. One of the easiest and best ways to drop credit utilization is to pay off debt as much as possible. This is my favorite option. However, you can also try to contact your credit card company and ask for credit limit increase. The bottom line is to pay close attention to credit utilization, especially when you are just starting to build your credit or applying for a big loan, such as a car loan or mortgage. As you can see, with only these two factors, you are already covering 65% of your credit score, which is more than half of it. Before we dive into the next three factors that affect your credit score, if you are enjoying this video, please give it a thumbs up and share it with your family and friends who could also find it helpful. Stay tuned until the end and I'll show you where you can check your credit score for free today. Now, the third factor affecting your credit score is the length of your credit history. This has 15% weight on the overall score. This factor considers the longevity of your credit accounts, including the age of your oldest and newest accounts, as well as the average age across all accounts. It also looks at how recently you have used certain accounts. Often it is wise to keep your first credit cards open, especially if they are fee-free, even if you don't use them regularly. To prevent the card from being closed by the issuer, consider using it occasionally to keep it active. Generally, a longer credit history positively influences your FICO score. So if you are planning to start building your credit history, begin as soon as possible. The fourth factor impacting your FICO score is the credit mix you have. Your credit mix refers to a variety of credit accounts appearing on your credit report, such as mortgages, auto loans, credit cards, etc. This factor accounts for 10% of your credit score calculation. Having a diverse range of credit types can enhance your score, indicating to lenders that you can manage different forms of credit responsibly. However, it is important not to apply for every type of credit accounts at once. Rather, you should only apply for new credit when necessary. The fifth and final factor affecting your credit score is new credit. Applying for several new credit accounts in a short period can pose a greater risk to creditors, especially for individuals who are just beginning to establish their credit history. An inquiry is recorded on your credit report when you, your employer, insurance company, or a lender request to see your credit report or score. However, FICO scores only consider inquiries that truly impact credit risk, since not all inquiries are related to credit risk. There are generally two types of credit inquiries. First type are the soft inquiries. These typically occur when a person or a company checks your credit as part of background check. Soft inquiries do not affect your FICO score. Second type are hard inquiries. Hard inquiries are recorded on your credit report when you apply for new credit product, such as credit card or mortgage. These inquiries can affect your credit score. When you apply for new credit, inquiries remain on your credit report for 2 years. New credit accounts count for 10% of your overall score. Now you know all 5 factors affecting your credit score. A higher credit score generally means you will get approved for a loan or credit card and pay relatively lower interest rates. In case you wonder what is high or good credit score, let me explain. FICO scores have a range of 250 to 900 points. To have more chances of mortgage or auto loan approval, aim to have a credit score in the good range. A FICO score above 670 is considered good, above 740 is very good, and 800 and above is exceptional. And now, as I promised, here is where you can find out your current credit score. Online services like Credit Karma or a majority of your existing credit card companies will provide your credit score for free. Credit Karma provides your credit score from 2 of 3 major reporting agencies, TransUnion and Equifax, while credit company sources may vary. Knowing your credit score is crucial because lenders use it to decide whether to approve you for a new credit product or no. Of course, other factors are also considered, such as your income, employment history, and more. Here's where it gets tricky. You don't just have a single score. Each of 3 reporting agencies collects data independently, and they score your credit based on its data. But usually, your 3 credit scores will be pretty similar. Although, if you apply for a big loan like a mortgage, don't be surprised if the scores your lender is looking at are not the same as what you are seeing on your credit card issuer site. To find out 5 actionable tips on how to build and maintain exceptional credit history, be sure to watch the video above. Thank you so much for staying until the end. If you enjoyed this video, please give it a thumbs up, share it with your family and friends, and don't forget to subscribe to my channel. Haven't downloaded my free guide to jumpstart investing and building wealth? It is available at no cost, and you can find the link in the description below. See you in my next video.